Welcome. This is the second in a three-part series that looks at the cost categories to produce. In the last video we looked at cash cost. In this video we will look at what is called total cost, or sometimes all-in cost. Total cost includes all costs to actually mine the metal at each mine. It is not the company's only expenses though, so it is not really the complete cost to mine. We will look at the actual complete cost in the next video where we put it all together. Total cost includes the cash costs, which are the production costs to mine, plus depreciation costs, which are basically the cost of the equipment and the buildings spread out over time. To fully understand total cost, one must have a basic understanding of depreciation, depletion, and amortization. All three are basically variances of the same thing, and all three are listed together as one single line item on the consolidated income statement, which may be labeled only as depreciation. Let's break down depreciation, depletion, and amortization. Depreciation is the way companies expense the cost of an asset, like a piece of equipment, over its useful life. Let's look at an example. Let's say a mining company buys a piece of heavy equipment for $100,000. The equipment is expected to last for 10 years, and at the end of 10 years, it can be sold for $10,000. Therefore, that equipment loses $90,000 of value over 10 years. When the company first buys the equipment, it records an asset worth $100,000 on its books. Each year, the company depreciates the asset by 10% or $9,000. In other words, it lowers the value of the asset by $9,000 and records that depreciation of the equipment's value as an expense on its books. Amortization costs are like depreciation costs for non-tangible assets. For instance, if a company has to pay a license fee every 10 years to operate, it will amortize the cost over 10 years. In other words, on its books, it will spread the cost out over the 10 years. Depletion is like depreciation, only instead of spreading out the cost over time, it is spreading out the cost over the amount of reserves that the mine has. For example, let's say that a mining company spends $20 million developing a mine that has 40 million ounces of silver in reserves. The mine will apply 50 cents of developing cost to each ounce of silver. At the end of each year, the company will multiply the number of silver ounces mined that year by 50 cents an ounce and record that as a depletion cost. In addition, depletion costs include the cost for closing a mine after all the minerals are removed. These costs are also spread out over the life of the mine. However, most mining companies will list mine closure costs as a separate line item on the balance sheet. Let's look at total costs using Pan American again as an example. We first take the cash cost of $285.7 million. Again, this is the cost of actually producing the metal, including material, labor, utilities, smelting and refining costs, etc., minus the income from selling the byproduct metals. To fully understand cash costs, please see the previous video in this three-part series. To calculate total costs, we add the cash cost, depreciation, depletion, and amortization costs, which in the case of Pan America is about $108 million. We add closure costs, which is technically a depreciation cost but listed separately. There is another change in inventory section. Change in inventories is the change of value in the metals that are in process or in inventory. It is the change of value of all metal that has been mined out of the ground and being worked on, or is finished waiting to be sold. This is sometimes referred to as change in work. A mineral producer has more than one section that is technically considered inventory, so there are more than one change in inventory sections in the report. There are some other miscellaneous costs and credits. There is a credit for non-controlling interest. We add together the costs and credits. We then divide the total by the number of silver ounces produced to attain the total cost per ounce. For Pan America, the total cost add to just over $400 million, and they produced a little over 23.7 million ounces of silver. Dividing the total cost by the ounces produced gives Pan Am a total cost of $16.88 per ounce. So that is total cost. Again, this is the actual cost to mine the silver out at each mine, but not the complete cost a mining company has. In the next video, we will look at the complete cost to produce. See you then.